It's a regular Monday morning. You open your IRA app, just like you do every week. Silver hit $121 in January. You rode that entire wave. Your stack is up. Life is good. But then you scroll down to the fine print of your storage agreement, the section nobody reads, and you see 3 words that should stop you cold: substitution, commingled, collateral. What do those words actually mean for your retirement savings? I'll tell you, and I promise by the end of this video, you'll never look at your IRA custodian the same way again. Today we're going somewhere that most financial channels won't touch. We're going inside the legal mechanics of physical silver custody, the part that's not in any brochure, the part that your custodian sales rep definitely didn't explain on the phone. Stay with me, because that's where I show you the actual contract language that makes this possible. And it will genuinely shock you where silver stands right now. Deliver conversationally, no teleprompter stiffness. Before we get into the legal mechanics, let me quickly orient you, because the timing of this video matters a lot. Silver opened 2026 on a historic run. We hit $121 an ounce in January. That's not just an all-time high. That's a number that 3 years ago, most analysts said was impossible by 2030. Yet here we were. And then today, March 2026, silver is down nearly 7% in a single session. It's currently trading around $68. That's a brutal pullback. Headlines are using words like crash and bloodbath. Now here's what's interesting, and this is the thing that the average investor completely misses in a moment like this. The paper price is crashing, but the physical metal, it's still walking out the door. LBMA vaults in London, the world's biggest physical silver market, drained another 60 million ounces in just January and February of this year. COMEX registered inventory, the metal that can actually be delivered against futures contracts, sits at only 79 million ounces. Compare that to the paper. COMEX has 114,000 open contracts. Each one represents 5,000 ounces. Do the math. That's 574 million ounces of paper claims against 79 million ounces of deliverable metal. That is a 7-to-1 leverage ratio on physical metal. So why does any of this matter for your IRA? Because the system that creates this leverage, the COMEX to custodian pipeline, runs directly through the same vaults where your retirement silver is sitting. And that's where things get interesting. Here's the question you need to be asking, and almost nobody is. When there's a physical delivery crunch on COMEX, where exactly does that metal come from? Stay with me. How a Precious Metals IRA actually works. The basics educational. Keep pace up. Don't get boring. Let's take 90 seconds to make sure we're all on the same page. Because if you're new to this channel or new to physical metals, this part is critical for everything that follows. When you open a Precious Metals IRA, 3 entities are involved. Entity 1, the custodian. This is the IRS-approved administrator. Names like Equity Trust, Gold Star, Strata, or Entrust. They hold the account paperwork and handle IRS reporting. They do not hold your metal. Entity 2, the depository. This is where your silver actually lives. Facilities like Delaware Depository, Brinks, AM Global, or Idaho Armored. These are physical vaults. This is the entity we need to talk about today. Entity 3, you, the IRA owner. IRS rules say the metal must stay in an approved depository while it's in the IRA. You cannot take home delivery. You cannot hold it yourself. Your only legal connection to that metal is a contract. Now here's the part that trips up almost everyone, and it's completely buried in how these accounts are marketed. There are 2 very different storage arrangements, and most investors don't know which one they have. Segregated storage. Your bars have serial numbers. Your name is attached to those specific bars. In theory, if the depository goes under, those bars are identifiably yours. Commingled pooled storage. Your silver is mixed in with everyone else's silver. You have a fractional claim on a big pile. You don't own specific bars. You own a number in a ledger. Most custodians market segregated storage as the premium option, and it costs more. So investors pay extra, feel reassured, and move on. But here's what the brochure doesn't say, and this is where the story gets a lot more complicated. Even with segregated storage, there are substitution clauses buried in the bailment agreement that allow your specific bars to be moved, swapped, or used as collateral, often without direct notice. I'll show you exactly how in the next section. The rehypothecation mechanism, the actual trap. This is the core section. Slow down, be deliberate. All right, this is the part I've been building to. Let's define the term that's at the center of this entire issue. Rehypothecation is when a financial institution takes an asset that was pledged to them as collateral and then uses that same asset as collateral for their own borrowing. The asset is pledged twice, sometimes 3 times. That's the re in rehypothecation. This was one of the key mechanics that blew up during the 2008 financial crisis. Banks had rehypothecated client assets so many times that when things fell apart, nobody could figure out who actually owned what. Now, how does this apply to your silver IRA in 2026? Let me walk you through the chain. Step 1. Your IRA silver sits in a COMEX-approved depository. Many major IRA depositories are also listed as COMEX-approved warehouses. That means your vault is part of the same inventory system that backs COMEX futures contracts. Step 2. When delivery demand spikes on COMEX, as it has been doing in 2025 and 2026, that vault needs to move metal from eligible status to registered status to fulfill deliveries. Eligible metal is metal sitting in the vault, but not yet available for delivery. Registered metal is cleared for delivery. Step 3. Under stress conditions, liquidity crunches, delivery failures, margin spikes, the vault can invoke contractual rights to reclassify, move, or use metal from its eligible pool to satisfy registered obligations. If your metal is in that eligible pool, your bars are in that pool. Now the really important part, this doesn't happen loudly. There's no headline that says, IRA silver seized. It happens quietly, through contract rights. Your statement still shows the same number of ounces. You just don't own the same bars anymore. You might own a claim on bars that are now somewhere else entirely. And the precedent for this is real. MF Global, the brokerage that collapsed in 2011, had segregated customer accounts that got frozen and raided during the bankruptcy. Customers who thought their assets were completely protected discovered that segregated is a legal term with a lot of interpretive flexibility. The SLV Silver ETF, if you read the prospectus, explicitly states that in certain circumstances, authorized participants can substitute non-conforming metal. Your IRA Custodians bailment agreement may contain similar language. I know this sounds extreme, so let me show you exactly how to audit your own account and what to look for in the fine print. That's coming up in just a minute. Don't go anywhere. The legal evidence, what the fine print actually says. Show documents on screen. Visual proof is key here. I want to be precise here because I'm not making allegations against any specific company. What I'm doing is showing you the categories of contract language that exist in this industry. Language that is publicly available in standard bailment agreements and IRA custody documents. There are 4 specific clauses you need to understand. Clause 1, the Substitution Clause. Language to look for. Depository reserves the right to substitute equivalent metal of the same type and purity. This means they can swap your specific bars for other bars of equal weight and grade. You won't notice it on your statement. Your serial numbers just quietly change. Clause 2, force majeure during market disruptions. Language to look for. In the event of market dislocation, exchange disruption, or systemic liquidity event, depository may take actions it deems necessary to preserve the integrity of the facility. That is extraordinarily broad language. In plain English, if COMEX melts down, they have discretion to do almost anything with what's in the vault. Clause 3. Collateral financing arrangements. Some depositories offer custodians financing arrangements. Essentially, the depository loans money against the aggregate metal it holds, with the pool of metals serving as collateral. Individual IRA holders in that pool may be party to this arrangement without realizing it. Clause 4. Commingling without clear opt-out. The most common version, the default storage option in many IRA agreements, is commingled, not segregated. Segregated costs more and requires an explicit election. If you didn't specifically choose segregated storage and confirm it in writing, there's a real chance your metal is in a pool right now. Now, and this is critical for fairness, many reputable depositories have clean agreements with no rehypothecation policies, strong segregation guarantees, and transparent auditing. This is not a universal problem, but it's also not a niche problem. It lives in the fine print of a huge percentage of IRA storage agreements in use today. Coming up, the exact steps to audit your own account right now. This is the action section. I've got a free checklist. Grab it from the pinned comment below while this next part plays. Your action plan. 5 steps to verify your silver is really yours. High value. Deliver this with authority and calm. All right, here's the practical side. Whether you've been stacking for 20 years or you opened your first IRA account 6 months ago, these 5 steps apply to you. Step 1. Request a full bar serial report. Contact your custodian today and ask for a bar-by-bar inventory report, including mint marks, serial numbers, and weight. A legitimate segregated storage arrangement will have this available immediately. If they hesitate, give you vague answers, or tell you it's not possible, that is a serious red flag. Step 2. Read your storage agreement. Download the full bailment agreement from your custodian's website, or request it directly. Search the document for the words substitution, commingled, collateral, rehypothecation, and force majeure. The presence of these terms doesn't automatically mean your metal is at risk, but you need to understand the context in which they're used. Step 3. Confirm your depository's COMEX status. Go to the CME Group website and look up the list of approved COMEX silver depositories. If your depository is on that list, your vault is integrated into the COMEX delivery system. That's not automatically bad, but it means you need to be especially clear about the segregation terms in your agreement. Step 4. Consider non-COMEX depositories for maximum isolation. If you want the cleanest possible custody arrangement, look for depositories that are not COMEX-approved warehouses. These facilities have no structural incentive or contractual pathway to reclassify your metal for exchange delivery. Your metal exists completely outside that system. Step 5. Diversify custodians and consider a partial physical holdout. From a pure risk management perspective, having all of your physical silver with one custodian inside one type of account is concentration risk. If you have the means, splitting between 2 custodians at 2 separate facilities significantly reduces your exposure to any single point of failure. And for those of you who are comfortable with the tax trade-off, some investors choose to hold a portion of their physical stack personally, completely outside the IRA system. I'm not a financial advisor, and this isn't financial advice. These are frameworks for asking better questions, and the most important question you can ask right now is, do I actually know where my metal is and what my legal claim on it looks like? The line that matters most. Deliver slowly. This is your brand statement. I want to leave you with one thought, and it's something I've come back to again and again as I've researched this topic over the past couple of years. The original argument for owning physical silver, the argument that separates physical from paper, is that you own the real thing. Not a derivative, not a claim, not a promise, the actual metal. But if your physical silver is sitting in a vault that is part of the COMEX delivery chain, under a custody agreement with substitution clauses and commingling language, you might not be as far from paper as you think. If you don't hold it and verify the specific bars, you don't fully own it. That's not a scare tactic. That's the legal reality of how these agreements are structured. And now that you know it, you can do something about it. If you found this valuable, hit the like button. It genuinely helps this research reach people who need it. The pinned comment below has the free IRA custody checklist PDF. Use it. In the next video, we're going in on the SLV ETF prospectus, because if you think the IRA situation is complicated, wait until you see what authorized participants are legally allowed to do with physical ETFs.